I am all for paying the taxes you owe. I'm not a fan of tipping the IRS.
Think getting a tax refund means you're winning? Think again. Today on Midland Money Mindset, we're bringing in Steven Jarvis, CPA, a game changer in tax planning and the CEO of Retirement Tax Services. With over a decade of experience, Steven is on a mission to help you stop tipping the IRS and start keeping more of what you've earned. Because let's be real, overpaying taxes is not a badge of honor. He's been featured in Advisor Perspectives, runs the Retirement Tax Services podcast, and has even taught at Whitworth University's business school. Steven has seen it all, from costly tax mistakes to missed opportunities, and today he's breaking it down so you can take action now. Get ready for an eye-opening conversation that could change the way you think about taxes forever. I'm Larry Sprung, your host for the Midland Money Mindset and founder and wealth advisor of Midland Financial. Let's dive into today's show. Well, Steven, I am excited to have you today. As I've told our listeners, you're the CEO and head CPA at Retirement Tax Services. So we're just going to jump right in. Our listeners are so fascinated by the entrepreneurial journey. Can you talk about your journey to founding Retirement Tax Services? And we'll talk a lot about what you're doing today. But how did you get here?
Yeah, it's a great question. One I definitely get a lot because nobody's surprised to find out that most people don't grow up just dreaming of someday being an accountant. That's not when you're in sixth grade and doing your career presentation. It's doctor, lawyer, astronaut, hockey player. It's not, oh, I want to be a CPA someday. And that was also true for me. I was pretty hooked on. I wanted to be a firefighter. At one point, I was trying to figure out how to become a brain surgeon. And then just the practicalities of life kind of caught up with me of, you know what, I really want a job. I want to earn money. I want job security, those kinds of things. And so I went to college because I thought you were supposed to. I took an accounting class because the counselor told me I should. And then when I was in my accounting class, I kind of looked around and said, oh, this seems really challenging for everyone else, and just kind of clicks for me. And so that's really kind of my origin story of why I went the accounting route. And then when I became a CPA, started in public accounting, I knew really early on I didn't look and sound like most CPAs. It just took me quite a while to figure out what I wanted to do instead. So I did a decade at big national accounting firms doing probably whatever you imagine a CPA stereotypically does. That was me. And then I had this opportunity to create Retirement Tax Services and become an entrepreneur, and was really kind of surprised how excited I got at the idea of starting my own business. And here I am 4 years in.
Great stuff. Great stuff. So let's dive in a little bit about, taxes and the importance of it, some misconceptions, misperceptions, right? One of the things we hear very often from people are, hey, I got a tax refund this year, right? And they get super excited about that tax refund. Why are you not necessarily winning? Why are you not in a great place if you get a tax refund?
So this is probably one of the most common misconceptions that I have to clear up, because it takes all the focus away from the right things. And if you watch, any of the ads you see on the internet or on TV around taxes, it's always about let's maximize your refund. The problem with that focus is that a refund versus payment at tax time is only a reflection of how much you gave the IRS during the year. It has nothing to do with how much you actually paid in taxes or saved in taxes. I can make everyone get a $100,000 refund. It's just on December 31st, you need to send an extra $100,000 check to the IRS. And eventually, might take weeks or months, they'll send it back to you. And so you can call it an interest-free loan to the IRS, however you want to think about it. It's just a timing issue. It's not actually winning.
Yeah. So I think that's interesting, because I think people think they win, right? And I think you bring up a good point as well, right? Taxes aren't necessarily something that you should be thinking about, it sounds like, once a year. So how do we break this cycle of people thinking that tax time is only when they file either their business tax returns in March or their personal tax returns in April? How do we get them beyond that one time a year thought process?
I think understanding just how big your tax bill is the first step. The next step is understanding that there are things that we can do. And I'm not talking about hidden accounts in the Cayman Islands. I don't look good in orange. We want to pay the taxes we owe. But if we understand that there are options available to us, even if that's as simple as adjusting our withholdings or making estimated payments so there aren't surprises at tax time, then it starts being something we want to think about more often because just as humans, we don't like to dwell on things we can't impact. And so having that understanding, breaking that myth of, hey, there is something we can do. And depending on if we're a W 2 employee, we're retired, we're a business owner, what we might be able to do is going to be different in those different situations. But we at least want to understand here's what I should be evaluating each year, or here's what someone on my team should be evaluating. You don't have to be the tax expert yourself if you don't want to be, but you or someone on your team needs to be evaluating these things every single year. One of the things I do with every taxpayer I talk to is I stop on line 24 of their 1040. So everyone files a 1040 each year. Line 24 is your total tax. That's the amount of your hard-earned money the IRS kept last year. And that's a much more important point of reference because it illustrates for us just how much of our money goes to taxes. And I am all for paying the taxes you owe. I'm not a fan of tipping the IRS. And by that, I mean, we want to be proactive and intentional about taking advantage of the opportunities that are available, but we have to have that framework for this is how much of my hard earned money they kept. Because, Larry, I'm sure, like you, I talk to people who will excitedly tell me that, well, I don't pay taxes, I get a refund. And when I point out to them, no, actually, the IRS kept $60,000, $80,000, $200,000 of your hard earned money. It's this mind blowing moments for them of, oh, I had no idea just how much of my budget goes to taxes each year.
Now, are there certain things that people should be evaluating at certain times of year, kind of going along that path of, not just thinking about it one time a year, but are there things that, they should be looking at in, the first quarter, second quarter, third quarter, fourth quarter, et cetera?
Especially for people who are new to this, the way I like to start this thought process is, okay, you have to file a tax return. Most people are pretty good about that. They don't want to go to prison or have the IRS come knocking on their door. And so they at least think about taxes in March or April. So the natural next step is, okay, as soon as you filed last year's tax return, let's think about what that means for next year. So we're not even necessarily adding a new time on the calendar to think about it, but we're taking that extra step of, I just finished my 2024 taxes. What do I know is going to be different in 2025? And is there anything I should do just to affect the amount of my refund, the amount of payment due, to make sure I avoid underpayment penalties? And especially if there are life events, I'm going to change jobs, I'm going to move out of state, I'm going to have a kid, my kid's going to move out of the house, whatever those are. So that can be a good first step to say what's going to be different next year. And then I also am a huge fan of Q3, Q4, that September, October timeframe, when most of the year has gone by and we know at least some of what actually happened, to then give ourselves a few months before the end of the year to say, hey, did I want to contribute more to a 401k? Did I want to convert money to Roth? Did I want to figure out what this whole backdoor Roth contribution thing means? Did I want to be more intentional about my charitable giving this year? Having some of those conversations in September, October gives us some time to then execute on before the end of the year.
Yeah, I think though that's some great advice. And one of the things that we stress here at Midland to the families we serve is, before taking money out of accounts, that they should reach out to us, not because we don't want them to enjoy the money or not take it out. Really, all withdrawals are not necessarily created equal, right? Depending on the type of account it may be coming from, it may all be taxable to them. It may be a function of selling some of their assets and creating capital gains. What have you found, as a good strategy for helping people to understand that all withdrawals are not necessarily the same and can impact not only short-term taxes, but also their long-term plans as well?
The best experience I've seen for taxpayers on this topic is when they work alongside someone, whether that's a financial advisor or a tax professional or a combination of the two, who reinforces tax concepts along the way. Because if you go to take, especially a large sum of money, hopefully this is for something fun like an RV or a big trip. It might be for something that's not fun, like medical expenses or a new roof. But especially when it's a large chunk of money, if you've never had someone explain to you, here's how the different tax buckets work. Here's the type of income that's subject to ordinary income taxes versus things that are tax deferred versus, you mentioned capital gains. There are preferential rates on certain types of income. And then, of course, there's my favorite bucket, which is our tax-free bucket, which for most people is a Roth bucket. And so if someone has never heard of these things before and they're going to take that large sum of money, it's going to be hard to then go back and wrap your mind around these concepts because now you're just focused on, hey, I want this money for this thing I either have to or want to do. And so I think some level of education along the way is what makes the difference so that we can reinforce those things along the way. I do like how you phrase this, that you work with the families you serve to make sure you're reinforcing, hey, talk to us first so that we can be proactive about this. Because there are things we can do. To your point, not all withdrawals are created equal. Even if we have just a couple of months of notice to say, hey, do we do this in one tax year versus another tax year? Do we do this from a combination of accounts or all from one account? If we know we're going to take this chunk of money, do we go ahead and take a little bit more and get it all in the same year, knowing that you're going to use it next year? There's some things here that we can be strategic that go back to that idea of we want to pay the taxes we owe, but we don't want to leave a tip. And if we can be strategic and intentional, we can avoid tipping the IRS.
Imagine a relationship where financial conversations don't feel stressful, but actually bring you joy. We've designed a guide to help you have positive, meaningful money conversations with your partner. This isn't just another budgeting tool, it's a roadmap for building trust and connection. So if you're ready to start a joyful money journey with your partner, go to mitlan.us/couplesjoy and download your free guide. Transform your financial future together starting today. Yeah, and I think you bring up a good, right? I think it's all about having that open line of communication, right? Whether you're doing your own taxes and your own tax planning or using a team like, your services at Retirement Tax Services or our services, through, our relationship with firms like yours or other firms, or just from an investment standpoint, having that open line of communication is super helpful because if you just call up or arbitrarily take out the money, then, if there's another event that takes place during the year, and we didn't realize that money was taken out, for example, there may be other ancillary impacts as a result of this new concern that you have that we weren't aware of. But I think the key is that you're stressing is communication is really paramount when it comes to tax planning, it sounds like.
Absolutely. And you just described it in there, but I want to put a really kind of fine point on it of all of these different pieces of your income and expenses and withdrawals. These are all interrelated. And we have to remember that because when we look at the tax brackets or the different tax rules, the tax code, the IRS does not put all of these things individually in silos. So you can't just say, hey, I want to withdraw $40,000 to take my entire family on this huge European vacation. Something I wanted to do my whole life. Let's go do it. We don't just look at that one withdrawal in isolation. We have to know, well, what already happened earlier this year? Did we rebalance our portfolio and that created income that we need to talk about? Did we get a big bonus at work or we had RSUs vest or whatever that might look like? All of these things get combined throughout the year when the IRS goes to look at them. And so we've got to be conscious of how those different things have already transpired when we make our next decision.
Agreed. I think one of the issues or challenges is combining what happens now today with what may happen in the future. And that may be future years, that may be future in the same year, and, how that biggest impact can be. So, why is long-term planning such an important part of taxes?
Yeah, I think there's a few things behind that. One is just the ability to be intentional. Usually, if we're making long-term plans, we're spending more time on what's the overall strategy behind these things. We're not making as impulsive decisions. And just the way the tax code is written, if we take the IRS 1 year at a time, they almost always win. And really, part of the reason behind that is tax rules are all written by Congress and politicians. And most of their election cycles and budget cycles are short term. And this isn't a statement on any particular political party, it's an observation about how the system works. And so a lot of the tax code is focused on generating short term revenue. And so when we can take a step back and say, okay, I'm not worried about my life in the next year, I'm worried about the next 40 years, I'm worried about the next 80 years because I'm thinking about my heirs as well. That's when we can start saying, oh, because of that short-term focus from the tax rules, if I can take a long-term focus, I actually can start taking advantage of some of these things. And so this comes down to understanding what our current tax rates are versus what we expect them to be in the future, whether that's our own personal tax rates because of our income. That's if we're concerned at all that Congress might raise tax rates in the future. These things start to play together where when we're, for example, if we're in our peak earning years, we just hit the top of the mountain in our career and we're earning more than we thought was possible. It's very likely that at some point in the future, we're going to earn less, and that creates some opportunities for future planning. So there might be things that we defer into the future. There might be things that we accelerate into the present, but it's all based on understanding what we expect now versus what we expect in the future.
And I think one of the things that you're like, mentioning without mentioning, right? Or one of the things I think about as I hear you talk about that is, people have been conditioned to, do things in order to save taxes, right? Whether that makes sense for them or not. And what I mean by that is, right, lower income earners in their, let's say, 20s, right, who may not be in a very high tax bracket, have somewhat been conditioned, oh, well, I should probably be putting money in an IRA towards my retirement or a traditional 401k. I get a tax deduction. But in reality, they may be in the lowest or the second lowest tax bracket. And I think to your point, they would probably be better served from that longer term perspective, perhaps using a Roth IRA,
Yeah.
foregoing that tax deduction today, because it's really not that great, and have that money grow tax-free. So they have that tax-free bucket if they want to buy that RV, take the family on vacation later on and not have to worry about the tax ramifications, and kind of build up that pool of money rather than being conditioned that, oh, well, I'm going to put it in an IRA or traditional because I need a deduction. I mean, is that what you're talking about, and having that long versus short-term view?
That's certainly a piece of it. I like that you mentioned how we've been conditioned to think about taxes because that's certainly a piece of it. We've all been it's been instilled in us that the more we can do to save taxes now and to get a giant refund now, that is always the winning scenario. And that's just not the reality. Since you mentioned traditional versus Roth contributions, I want to highlight this because this is another common misconception, and it fits into our conversation about long-term planning. Depending on how you first heard about traditional versus Roth, again, you might have been conditioned to think about it one way or another. I hear a lot of people talk about the break-even point on traditional versus Roth as if some certain amount of time has to go by before that makes sense. But the entire discussion around traditional versus Roth really comes down to tax rates now versus tax rates at some point in the future when you need that money. That could be a year from now, that could be 50 years from now. But if tax rates don't change, there is no difference between traditional and Roth IRA. If we would put the same amount of money into traditional versus Roth, we end up in the same place. And I'm a tax nerd, so I've done the math 1,000 different ways. You can pull out your spreadsheet and double check me. But at the end of the day, traditional versus Roth is all about tax rates now versus the tax rates we expect in the future. And so if we don't take time to think about that, to acknowledge, hey, wait, I'm in my mid-20s and I haven't hit my peak earning years yet. Or I'm in my mid-60s and I just retired, but I haven't hit Social Security yet. We have to have these relative understandings of what our tax rates are now versus what they might be in the future.
Yeah. And well, I think you also have to take into account that if that money passes along, what are the tax rates potentially of the heirs, the beneficiaries, right? So if they're even higher than you have to take that into account as well. So it's a complicated, it's a complicated calculation for sure. And for everybody, it's going to look differently. And I think this leads nicely into what I wanted to talk about next, because you've been heard saying, and this is a quote, taxes should be a passenger on the bus, not the driver. The most benefits to the family is to look at the full picture. And for that reason, you do not do tax returns for anyone who's not working with a financial advisor. So can you elaborate more on why it's so important for financial advisors and CPAs to work together? Because I think this is vitally important and sometimes missed by many.
Yeah, I think we all have, at some level or another, have experience with the medical system. And that could be a whole separate series of podcasts, but it's just an analogy that resonates with people. I really look at this as going to your general practitioner versus going to an orthopedic surgeon. And when you go to the general practitioner, you want to make sure they understand a wide variety of things can help you in a lot of different directions. You want them to facilitate recommendations and referrals. You want them to understand those pieces that are most important in your life and then get the specialists involved where necessary. And so in this analogy, I'm more of the orthopedic surgeon where I'm the tax guy and I only want to be the tax guy. But to your point, that the quote that I like to use that I've heard from others as well, taxes are a passenger on the bus, but not the driver. However you want to think about that, taxes are not the most important thing in your life. And so the other thing I like to say is let's make good life decisions and then figure out the most tax efficient way to go about them. Because if we're not thinking about the tax decision in light of everything else you're trying to accomplish, it's possible we could make a good tax decision that's a terrible life decision or a terrible investment decision or whatever. It might be a terrible estate planning decision. There's all of these overlaps here. And so from my perspective, and what I've seen, so I grew up around financial planning, and then I went the stereotypical CPA route, and now I spend all of my time working around financial advisors. And financial advisors tend to be in this really great position as that general practitioner to say, here's all the different pieces of your financial life. And then here's Steven, a specialist that we can incorporate on the tax side.
One of our core values here is know your expertise, collaborate when needed, right? Because I think it's important to do that. But do you feel like you're the model that you've established with working with the financial advisors? Do you think that creates better outcomes for the families that they serve as a result, and you serve, obviously?
Yeah, 100%. To your point, that's why we set up the company this way. And 4 years ago, it was a little bit of a theory. I mean, we'd seen other people do things adjacent to this. Now it's 4 years into this exclusively working alongside financial advisors. I'm more convinced than ever that this is the way to go. And again, I mean, similar to the medical analogy, that doesn't mean you need a CPA in the room every time you make any life decision, right? To your point, collaborate when necessary. I definitely work with advisors at times who they'll say, hey, I have this client. Is this somebody that we should work together on? When I see the situation, I say, you know what? Honestly, if they keep DIYing their tax return with your help, they're going to be just fine. Like I don't need to do every tax return for every person in the world. I want to be involved when it makes sense. But I do see the best outcomes when there's that collaborative environment.
So, I think that taxes, and since you use the medical analogy, we'll go in this direction. I find taxes, or believe taxes and medical expenses are often some of the largest expenses that folks in retirement see. Why is it so important to set up a tax plan before you enter that retirement period?
That's a good point to reinforce as often as possible, because I think it catches a lot of people by surprise as they go through life, let alone as they get into retirement. The taxes really does represent such a big piece of this. And especially for people who spend a lot of their career as a W-2 employee, which is a great way to go about life. And you can set yourself up really well for retirement. But there can be a lot of surprises that come when you go from, I have a single source of income, my tax return is very simple, to wait, now all of a sudden I've got to think about Social Security and pensions and IRA distributions and 401k distributions and Medicare, and how are my premiums impacted by the amount of taxable income I have, and all these different pieces. It suddenly gets very complicated. And so if we wait until life happens to us, we're left with very few options. Whereas if we plan ahead, if we have a 5, 10, 20-year plan, and when I talk about a multi-year plan, this does not have to be this elaborate binder that's 70 pages long of every possible outcome and what is the likelihood of each one. This can be as simple as, hey, let's write out on a piece of paper the major events we know are going to happen in the next 10 years, and are there decisions we need to make relative to that? And of course, we can go deeper and get more intricate, but I don't want people to feel like this is insurmountable unless they have the entire in-depth analysis.
Listen, I love that point, because I think when people think about planning and kind of having a strategy for 1, 3, 5 years, they do think it's got to be this elaborate plan, and it becomes overwhelming and it causes them paralysis by analysis and a lot of times to do nothing. Whereas if you can make it a little bit easier, there'll be a little bit more action as a result. So great point. So let's shift for a moment, because the Secure Act, which was passed recently, we've also seen the Secure Act 2.0, was one of the biggest changes in taxes and planning retirement in years. And we've seen that impact on the families that we serve. As this this great wealth transfer that we continuously are hearing about is in the myths. I think one of the biggest changes has been around inherited
Mhm.
IRAs, where people used to leave their IRAs or their retirement assets to their loved ones, and they'd be able to stretch it out over their entire lifetime. And now they can't. So what, in your view, what is important for people to understand about this inherited money, whether they're the one that's going to be leaving it for the next generation,
Mhm.
or you're a member of the next generation feeling like you're going to inherit these assets at some point from that family member?
I definitely get a lot of questions around Secure 2.0 and inherited IRAs. And the crazy thing is that it actually isn't that recent anymore. It's been a few years since they
Right.
originally passed it, but they kept punting on enforcing it and interpreting it. So it has been very recently, just this last year, where they finally said, no, this is what we meant all along, and now go ahead and do it. The biggest confusion came around required minimum distributions for inherited IRAs. Because, like you said, it used to be that you could stretch these out over the lifetime of the beneficiary. And Secure 2.0 changed it to say that if you are a non-spouse beneficiary, then you have 10 years to distribute the entire balance. And so, great, we got this 10-year period, which to what we've been talking about all along, you want to be intentional. If you do that, if you distribute that money all in year one or all in year 10, in most cases, you're going to get killed on taxes. Now, there could be a
Right.
situation where that's what makes the most sense, but most of the time, you're going to get killed on taxes. We want to understand what's going to go on in those 10 years. And a lot of people will get hung up on what's the required minimum distribution. I like to go past that and say, well, how much should we take out? Because often we probably should take out a lot more. That's getting a little bit nuanced and definitely needs to be applied to a specific situation. But to this required minimum distribution piece, the RMDs, because that's the most common question I get from a really high level, how this works is if the person who owns the IRA, the decedent, if they were taking required minimum distributions, the beneficiary will also need to continue taking required minimum distributions. The amount's going to change, but we want to look at, was the decedent taking them? Okay, we need to keep taking them so we don't run afoul of the IRS.
Yeah. So it's really something that you can't just, there's planning involved, right? You don't want to just take it all out in one year versus another. You want to plan appropriately over that 10-year period, and you might be able to accelerate it more quickly than that if it makes sense for you, or you may need to use the full 10 years is what I'm hearing.
Absolutely.
So let's talk about this, because you mentioned, DIYers,
Yeah.
and that there is a place for
Mhm.
do-it-yourselfers, simplistic tax return, might be able to, handle it themselves. But, with those DIYers, many times comes quote unquote free tax software, right? We always hear about, these various companies giving away their software for
Mhm.
free. Why can free tax software cost people money?
I think what catches people is that they think in the moment as opposed to long term, kind of like what we've been discussing. And so they say, "Oh, I can go get this free software. But I know my tax situation. The AI is part of the software. Like they're going to get me through it. It's fine." And and maybe that's true. I've seen plenty of DIY tax returns that were just fine. This is a big piece of your life, and just fine might not be what you're actually after. And so, some of the things that I start encouraging people to really look at is, as your tax situation changes, as it gets more complicated, as you get new types of income, as you constantly get killed on taxes at tax time because you're not sure how to adjust your withholdings, as you move states. I mean, I've got a whole list. You have life events that your family situation changes. Those are all things I point people to say, hey, maybe it's time to work with a professional. The other thing I like to remind people of is this isn't some kind of mark of whether you're a good person or not, whether you can prepare your own taxes. Don't look at it as this badge of honor. Look at it as so many other things in your life. Is would I rather just not have to worry about it? Would I like some of that time and stress back to be able to focus on other things? And so a lot of the DIYers that I end up working with, and I end up working with a lot, it's not that they screwed something up in or an irretrievable way. It's that they finally had that moment where they said, oh, it would be nice if I could just pay someone else to worry about this for me. And then as I work with them over time, then they start realizing more and more, oh, this is probably what I should have been doing a long time ago. To have someone else who doesn't do this one time a year, they do this hundreds of times a year. So you find someone who hasn't done this dozens of times in their life, they've done this thousands of times in their life. The other thing that really reinforces to people that they want someone else working along their side is when they start getting letters from the IRS, which we have seen start happening more and more frequently. Uh, d- Regardless of the headlines you hear about the IRS going away, it's not going to happen. And there's going to be a bigger and bigger emphasis on technology driving how the IRS enforcement works. And even just over the last few years, we've seen more and more communications going out to taxpayers. And that goes from I have a free software, I can do my own tax return to, oh no, what do I do now? And those are the times that our clients are most grateful to work alongside us is when instead of panicking and saying, how can I possibly handle this? They know that we're just a phone call or an email away. And they say, hey, Steven, can you help us respond to the IRS?
Yeah. So what I'm hearing is even if it doesn't save you money in the in the short run, it definitely saves you time, which at the end of the day, time is money, right?
Absolutely.
So let's hear it from you. You do taxes all the time. You do a lot of tax planning all the time. What is or are, the biggest one or two mistakes that you see most people making as it relates to taxes?
The single biggest thing is not being proactive. That's true for planning. That's also true for tax preparation. And so things can go on throughout the year, and then we get to tax time, whether somebody's doing their own return or they're having somebody else do it. Do we have proactive conversations about what this is going to mean on our tax return, or are we reactive and hoping this is all going to work out? Because a lot of people assume that because a W-2 goes out for their employment income, because a 1099 goes out for their investments or for their IRA, that, okay, the IRS has all the information, we can move on. And that's simply not the case. Most tax reporting by default does not get the job done. And so if we're not proactive in the conversations we have and the way we're thinking about our taxes, mistakes can get made, and they are very costly mistakes.
Yeah. So I think the huge takeaway from today's conversation is be proactive and have a plan and start having a game plan for these things. Don't just, as you said, be a passenger on the bus, right?
Yeah.
Just don't be going for the ride. So listen, Steven, it's been a pleasure having you on, and we ask each of our guests the same final question. Our listeners love hearing about what brings people joy because we are the Midland Money Mindset. And we're all about joy. And that is, what did you do today that brought you joy and put you in the right mindset for success?
Well, we're recording this pretty early in the morning, so my list of possibilities is a little bit shorter. But one of the things I do on a really regular basis, and I did absolutely this morning, is read. As we're recording this, my schedule is rather full. And so I'm not talking about reading an entire book every day. I literally read 2 pages, but I took the time to read it. And it was from a book I had read before, if I'm being completely transparent. But even just taking the time to say, where did I leave off on this? What's insight from someone else on how I can look at my day? Just to be able to start my day with some kind of framing of here's how I'm going to impact other people. Here's how I'm going to be successful. Here's how I'm going to find joy. So reading is one of those things that I time and time again find to have a huge impact on my life.
Amazing. So what was the book? Because obviously this one brings you a tremendous amount of joy. Can we share it with our listeners?
Yeah, the book's called So Good They Can't Ignore You. And maybe this especially resonates with me because I went into a profession that most people don't associate with passion inherently. But the book is really about putting the work in to be great at whatever it is you do. And so to not focus on, is this what I was born to do? Am I inherently passionate about this? It really focuses on, am I willing to do the work to become so good at something that people can't ignore what I'm doing?
Great stuff. Thank you for sharing that. And listen, Steven, we're going to have all your information and retirement tax services, their role in our show notes. But if people want to learn more about you, learn more about what retirement tax services does and want to connect you, what's the easiest and the best place for them to do that so our listeners could reach out?
Best way to find me is on LinkedIn, Steven A. Jarvis. Not today, but a recent thing that brought me joy. My 14-year-old daughter was with her friends and someone brought up, hey, we should play a game to see who can find our parents online the fastest. And my daughter said, I will win, I promise you. And nobody believed her, but there you go. Because I'm a tax nerd on LinkedIn, you can find me easily. There's lots of great content out there.
Awesome. So taxes are important. You're easy to find. Find Steven and connect with them and make sure you have a plan. So I appreciate your time. Our listeners, I know, will get a lot of great nuggets out of this, and they appreciate your time as well. So enjoy the rest of your day.
Thanks so much.
Wow, what an incredible conversation. A huge thank you to Steven Jarvis for dropping some serious tax wisdom and showing us how to stop overpaying the IRS. Your insights on smart tax planning, avoiding costly mistakes, and making money moves that actually build wealth were fire. Taxes don't have to be a burden. They can be an opportunity, and Steven just gave us the roadmap to make that happen. If today's episode got you thinking differently about your finances, take action. Steven, we appreciate your time, your expertise, and your passion for helping people take control of their money. Until next time, keep your mindset strong and your money smart. Steven Jarvis and Retirement Tax Services can be found across most social media platforms. All the contact information needed to find them can be found in the show notes.
The opinions voiced in the Midland Money Mindset Show with Lawrence Sprung are for general information only and are not intended to provide specific advice or recommendations for any individual. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risk, including possible loss of principal. No strategy ensures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Guests on the Midland Money Mindset Show are not affiliated with CWM LLC.